Hello, everyone. Hey, it's the day after Groundhog Day. Good for you. You didn't repeat. You're not stuck in a time loop. And that's a good thing because we have something really interesting to show you. This is episode 4 of the EdgeFinder signals reveal that I've been doing here. A couple of them last week. I'm going to do a couple of them this week. And I want to get right to a couple of stock picks that EdgeFinder has produced. They're really interesting ones. I'll explain why. Let me show you my slides and we'll get going on these. I got a few other things to show you tonight too, but meanwhile, here we are. 2 trades. First one is on LMND, Lemonade, and the second one is on Apple. You can see there's the numbers. You get in at this entry price or lower. Relative to wherever you get in, you set your stop loss at the red number and your take profit at the green number. Okay? So I'm going to let you look at those for a second, and then I'm going to show you a slide of each and tell you why these are so interesting. Because you see, if you were to make a trade where you get in at any random entry point and you set your stop loss $2 lower and your take profit $2 higher, it can be any numbers actually, just as long as they're the same. If you're risking the same amount to your stop and the same amount to your target, by definition, that trade has a 50-50 chance of winning or losing. Now, that seems so obvious to say, and yet most people don't know it. Because if that's true, you see, the whole 50-50 thing, then all you have to do to change your win rate is change your stop and target, the proportions, right? If you make a $4 stop and a $2 target, you're going to be twice as likely to hit the target first. Don't believe me? Test it out and you'll see. I have done this thousands of times in test and in real trading and found that these stats actually play through. All right. So if that's true, now look at these numbers one more time. Here I've got on Lemonade a stop loss of only $1.58 and a take profit of $6.79. Think about that for just a second and you'll realize randomness of prices does suggest that trade should be won less than 30% of the time, that it has less than a 30% probability of winning. Here's the big news though. The probability, according to EdgeFinder's calculations, is higher. Over there on the Apple side, a similar story. We're risking about 6 to make about 12. That trade setup suggests you should win that trade only 33% of the time. Again, EdgeFinder suggests it's more. Let's look at each one of them. Here's Lemonade. This is the setup on the chart. The numbers you just saw, but now they're graphically depicted. The pink area is the distance between your target entry and your stop loss. The green area, which is much bigger, is the area going all the way up to the profit target. Now, if you just look at those, you can see graphically, it's a small win to go for a small loss to go for a large win, almost a 4-to-1 proportion, which would mean that you have somewhere around a 25, we'll call it between 25 and 30% probability of winning. And that's just based on random price action. EdgeFinder does its math looking back over all the data available on a daily basis and says, under like circumstances, you have a 42% probability of winning this kind of trade. Now, you might look at that and say, whatever, it's less than 50%. I don't want it. Think about it one more time. If you could lose a small amount, but win 3 or more times that amount when you do win, and if you could win 42% of the time, right? Just imagine, it's like guy walks into a bar. You're already there. Dude walks up to you and says, hey, let's play this game where I've got dice and I'm going to roll the dice. And if I win, you pay me $1. But if you win, I'll pay you $4. And you say, fine. What's the criteria for winning? He says, I'll let you win if you roll a 1 or a 2, but you got to let me win on 3, 4, 5, and 6. Well, you know instantly you got a 33% chance of winning, but he's going to pay you quadruple for the winners. See how that works? As long as you have better than double, you're winning, and you're only going to win 33% of the time. With enough rolls, you're going to win. So your only question now is, how much money do you have, mister? And how many rolls do we get? How many rolls are we going to do this for, right? Given enough rolls, you roll 100 times, you're going to clean him out, even though you're only going to win 33% of the time. This one's even better. I don't know how you could take a dice and win it by 42% probability, but EdgeFinder knows you can do this with the markets. So this trade, most of the time, it won't be a winner, but when it wins big. If you take enough of these kinds of trades, they can pay off. They can pay off quite nicely. Here's the Apple one. Again, smaller risk area, right? And a larger win probability or win size, double the win size. The target's almost $12. The stop's almost $6. So you see, you're winning double. If you only won 33% of the time, you'd have a break-even system. This particular trade is calculated to have a 45% probability of winning. Maybe you don't win the next one, but if you do enough of these trades, the ones you do win and the size you win will really pay off. So that's this episode's 2 chosen picks. Not every one of these trades is a winner, but when they do win, if they win big, then they're going to pay you off. Let's look at the trades from last week. RGTI, it was a trade setup similar to Apple's. You risk 1 to make a little more than 2. And then there's Amazon, which was risk 1 to make 1, right? Randomness suggests that you should win the one on the left about 33% of the time, and Amazon about 50% of the time. Let's see how they played out since last week. Well, RGTI was a loser. We gave it out on this day as a trade signal and went right down. The great thing about losing a trade is it clears it off your plate and you're ready for the next one. So if you're going to lose, you want to lose quickly. That's trader mentality. But nobody likes to lose any trade if they can help it. But we think of it as a system. Each loss gets you closer to your next win. Here's Amazon. It's a short. Okay, this is Amazon going short. Now, all we got to do is get down $7.36 lower. Look at that entry. See, Amazon opened this day, went up, hit our entry point, came back down. First day, it was a great setup. Second day, yesterday, it was strongly against. Third day, today, it jumps up high and comes down. Almost hits the profit target on the downside. One more down day, I expect that'll be a winner. So that one's still open. We'll check it next time, and I'll come back to you once that trade closes, give you kind of a report on that. Newmont Mining was from a couple of times back, and wow, that was a big bad gap against. Didn't work out. Now, here's a little quote. If in fact you make a loss, you say to yourself, this, what Jim Rogers says, legendary long-term investor, buy when there's blood in the streets, even if the blood is your own. Well, the part I like about that is the idea that don't let losses dissuade you. Trust the system. I mean, get to a point where you trust your system, but then once you do, trust it, right? That's what he's trying to say. However, this is not my mentality. I don't subscribe to the idea of put a bunch of money in and just let it ride. You know, maybe if I were managing over $100 million of other people's assets, I'd think exactly like this. But when I'm trading my own money on short-term trades, I don't think like this. In fact, I would say it quite differently. I mean, look today at what happened. PayPal, down. Airbnb, big down. Shopify, down. I mean, all this red waterfalls is like, really? This is the definition of blood in the streets. Do I want to be a buyer now, today? Probably not. Well, certainly not if I don't have some system that helps me understand, helps me recognize whether or not I have a statistical advantage. In fact, here's the way I look at it. Buy if and only if you have a statistical edge. Okay, that's not Jim Rogers. Okay, that's me saying that. But the main thing is, if you have the statistical edge, you can feel confident about going forward. I think it's actually more in line with the spirit of what Jim Rogers was trying to say. But let me show you something here. I want to recognize or demonstrate to you a new trading system that I have come across. It still uses EdgeFinder, but it uses it in a different way than I've used it before, and I've just been amazed at the results. Let me show you some trades I did today. These trades are intraday trades on 0 DTE options. That's right. I am buying options set to expire on the same day that I buy them. I'm even waiting until the last 4 hours of the market. In fact, my experience so far suggests that maybe even the last 2 hours are the best times to be trading this. But here's what happens. I get some numbers from EdgeFinder based on where reversal zones should be. Here on IWM, I had anything above almost 263 and higher was going to be an area to go short. Anything below 261 was going to be an area to go long. But I'm looking to refine even better than that, not just anywhere down there. And then how much am I looking for once I get in? How much of a return or reversal? The size of that yellow box is the answer. In this case, a little less than $2, about $1.70. So wherever I get in, I want to try and take profit $1.70 higher. So I want to create a trade setup that allows the price to do whatever it wants until we get up $1.70 higher. And so I created a setup where I risk something like 3.5 to make just that one. Well, this setup should mean that I'm right 75% of the time. When I lose, I might lose triple my size compared to my winners. Well, that's if I were using regular old stocks. The reason this is so interesting for 0 DT options is when I get down to the last 2 hours of the day, the price of those options start getting less and less and less expensive. So I'm limited how much I can lose. And if in fact the reversal comes the way EdgeFinder dictates that there's a higher probability it should, then the amount that I could get paid off is larger than the amount I'm risking. Think about that. Imagine you had a dice rolling game, same kind of situation. Guy walks into the bar, gives you the dice and says, here, if you can roll 1, 2, 3, or 4, I'll pay you $2. If you roll in a 5 or 6, then you got to pay me $1. I mean, the first thing you're going to say is, well, is the dice fixed? Is this rigged? If he somehow assures you no, it's not, your next question is, am I going to go to jail for money laundering here? What is this? Because it's so ridiculously easy statistically to be able to win that game over and over again. Well, I haven't been going long on this system. I haven't been trading it very long. I'm just in the beta stages of it. But so far at the beginning, it feels like that. It's crazy. In fact, I want to demonstrate to you. Here's the trade also that I did on QQQ. These were amazing trades, but I want to go back and replay them for you bar by bar. So if I could just share you my screen, let me just show you. I'm going to start with the Qs, and I'm going to select this bar, and we're going to go. Hopefully this will make sense to you as I start trying to go through this. We're going to replay this so that you can see it the way I saw it earlier today. So right at this point here, it's at about noon Eastern time. Here comes a big candle. It's coming down, and I'm in the green area. Now, the the purple area up here, that's the short. If the price were up in here, I'd be looking to go short. But because it's green, I'm looking to go long. And see that little yellow box? That's the size of my profit target. Wherever I get in, all I'm trying to do is just get that small amount. On QQQ, it was $1.20. And then I give it lots of room for the risk. Now, I like to use this AT or a Keltner channel is what it's called. A Keltner channel with settings that 3 ATR away from the moving average, that sort of thing. Anyway, this Keltner channel helps me figure out where's a good point to get in right at the time the market opens. Yeah, I like to see it make a bump, come up, and then kind of come down. Wherever that bump is, that's the entry point. And you can see it comes really close to getting in there. So let me advance it a little bit and you'll see what happens. So there, right here at this price target, that's where I made an entry, the first entry. Now it's kind of early in the day, 12:35. And I got in there and I made that entry at about $1.65, I think it was. I'm trying to remember what I showed here on the slides a second ago. Let me see if I can get them up and then I can, yeah, there it is. Oh, no, it wasn't $1.65. It was $1.90. All right. So I got in here at the first strike out of the money that expires on February 3rd, today, 615 call option. At 12:35, I bought it for $1.90. Okay. And then we start going forward. Now, as it goes, it takes a little while. And then I noticed something else. See that little bump right there? How it comes down and then comes back up? I look at that and I say, hey, if the price ever gets down there, I'm going to get in again with a second entry. And so I did. I bought a second entry area here. The first one was $1.90, but this one here was only $1.04. So I could get in $1.90 and $1.04. Halfway through that, I'm at about $1.50, $1.48, something like that, right? But because it was cheaper, I could buy double the number of options and still risk the same amount. So I bought 1 unit of risk here and 2 units of risk down here. In both cases, I'm risking 1% of my account, right? And so then we go on and look at what happens. See, this is amazing to me. I didn't know this was going to happen. I didn't know this was a good reversal area. I've just been watching and back testing these for a long time. And all of a sudden, it comes roaring back up. In fact, it goes right through my profit target in that very first candle. Well, actually, about the third candle after I bought in. These are 5-minute candles. So here in 15 minutes, I was already hitting the profit target. This profit target is the same distance as up here. But in fact, I just watched it run a little bit longer and I got a better profit target than what I was expecting. I bought this thing for $1.04. I was able to sell it for $1.68. So 64 cents on $1.04, about a 60% return on risk just in 15 minutes. Not bad, says I. But then I was expecting this other one to just kind of end up being a total loss. I just kind of let it go, didn't even worry about it. Because in fact, if you lose these trades, then they just go to zero. But look at this. It came right back down to my old entry rate again, or entry price again. And I was able to make a trade here this time because it's later in the day. We're getting down to it. We're just like a little over an hour left before expiration. If I buy this thing here, I could buy it at 80 cents. So I buy it at 80 cents and then I wait to see it hit the profit target. And that one within the first candle or so, it already hit the profit target. But then it kept going. This is going all the way to the end of the day. Look at that. That's what it looked like by the end of the day. Just nothing but up. In fact, that first one that I bought, it ends up being profitable at the end. I mean, not much, right? But it ends up to the point where it's more than $1.90, just by a little bit more. This one down here, though, the one I bought at last, by the time it gets to the end of the day, it's $3.30. Now, $3, it actually went higher. $3.30 is what you could reasonably get out. That's the bid price a couple of minutes before expiration, end of day trading and that sort of thing. $3.30 off of an 80-cent purchase. Amazing, right? Well, I thought it was. And you look at it and, well, it is amazing. But it's not just one setup. Check this one out. Here's IWM, same kind of thing. When I come into, past 12 o'clock, there's the first, bump on that. That's my first entry spot. Get in there. It goes strongly against me. And so that trade, it's like, it's just going to lose. And in my mind, just like, okay, write it off. It's a loser. But then here's that another bump. And so that's my new entry spot. It comes in, same situation. And within just about 15, 20 minutes, it's well into the profit range. This one here, the profit target was wider. It was like $1.70 difference. And so from that point, I want to get $1.70. And this is on a $200 stock instead of a $600 stock like QQQ, IWM, right? But this option is going to expire right there. I don't know what's going to happen with the price. All I know is I'm going to put the trade on and I'm either going to lose it or I'm going to win it. And if I win it, it'll probably be bigger than what I went in for. Well, it turned out that the out of the money call at that one was 30 cents. The first one was $1.22. Okay. So I get in here at $1.22 and I buy, 1 unit of risk or, contracts that fit my account. Anyway, one amount. And then down here, I see it says 3X. I bought triple the amount because it was much cheaper. It was only 30 cents. That's great. I can buy this thing and triple the size of it and still have close to the same risk on both of the trades. When it gets done at 15.17 right here, that's when it hits my profit target. At that time, and in both cases, I'm buying the 260 calls, out of the money calls. And in these situations, the price was 30 cents here, $1.22 there. Because I bought triple of these, the cost basis on all 4 of the units was 53 cents. And when it gets up to there, it's $1.05. Now, if I had hung around and held on to the trade all the way to the end, that first one would have been profitable. And by the end of the day, they'd have been even more profitable. $2.85 that option would have been. And my cost basis on those was 53 cents. I would have had more than 4 times. I didn't because I'm just trying to take the profit targets on both of these. So I got $1.05. 53 cents was my cost basis, and I got $1.05. Nearly 100% return. And it was just these 2 trades. It was very simple. Now, if I had to do it over again, it had some sort of crystal ball that told me precisely what to do, I'd skip that first trade and just make the second one. Look at that. You could take 30 cents and come out with triple just getting to your profit target. If you're just careful and you want to watch it for the rest of the day, you could watch it go all the way up to 285. 285, like 9 times, more than 9 times what you paid for it. Pretty wild stuff, huh? Well, I thought it was. I'm going to be continuing to test these and research whether or not there is a trading system that is better than randomness on these high leverage instruments like 0DT options. I'm curious to know if you'd be interested in seeing that system in action and learning how to work it. If so, please do let me know. If I could bring up the slides again, I'll show you how to let me know. I want to give you the way to contact me here. So if you are interested in this 0DTE system trades in the last few hours of the day, you can either comment to this video on X or DM me I'm Gordon Scott CMT on both of those platforms, X and LinkedIn. I check them both regularly. Um, I usually don't check anywhere else. So if you're watching this on somewhere else, get over to one of these platforms and DM me. Let me know you'd be interested, because I'm curious to know whether or not this is the kind of thing that would be useful. A lot of people have day jobs, can't do a trade situation like this. Goofballs like me that sit around and trade all day, this is exactly what I'm up to. All right. And as always, you can check out myedgefinder.com and see for yourself where these trading signals come from and why they're so good. Till we do this again next time, everybody, keep warm, keep your booties on, as they say in Groundhog Day, and let's go forward, not repeat the same old mistakes. Take care. Trade well.